Have you ever wondered why some investors consistently make wise decisions while others lose money again and again, even in the same market? Have you ever felt overwhelmed by stock market noise, trends, predictions, and the fear of losing money? If you want to invest in a way that is safe, intelligent, and proven over decades, then Benjamin Graham's timeless masterpiece, The Intelligent Investor, is your blueprint. In this video, I will break down the most important ideas inside this powerful book, and by the end, you will understand how the greatest investor of all time, Warren Buffett, built his strategy from Graham's teachings. Stay with me until the end, because the last principle you will learn can completely transform how you choose stocks forever. Benjamin Graham is known as the father of value investing. He believed that investing is not about predicting the future. It is about protecting yourself from mistakes, avoiding unnecessary risks, and building wealth slowly, safely, and intelligently. He teaches that being an intelligent investor has nothing to do with IQ. It is not about being smarter than everyone else. It is about controlling your emotions, being patient, and making decisions based on facts, not feelings. Graham begins with one core idea. There are two types of investors, the defensive investor and the enterprising investor. The defensive investor wants safety, stability, and simplicity. He focuses on long-term strategies, low-risk assets, and automatic investing. The enterprising investor wants higher returns, but is willing to put in time, research, and discipline. Both strategies can work, but only if you choose the one that fits your personality. Now, Graham explains the problem most people face. Many investors think they are enterprising investors because they want high returns, but they behave emotionally. They chase trends. They panic when markets fall. They buy because of excitement and sell because of fear. This is not intelligent behavior. This is speculation. And Graham says very clearly that speculation is not investing. Speculation is gambling. Real investing is based on analysis, discipline, and safety. One of the most important lessons in the entire book is the concept of Mr. Market. Graham wants you to imagine that every day a man named Mr. Market knocks on your door. Sometimes he is cheerful, optimistic, and emotional, and he offers to buy your stocks at a high price. Other days, he is depressed, fearful, and negative, offering extremely low prices. The key message is this: you do not have to respond to Mr. Market's emotions. Your job is to stay rational while everyone else loses control. When the market offers you a low price on a great company, you buy. When he offers you a high price on a company you already own, you can sell, but you never follow his emotional swings. This idea alone has saved millions of investors from panic selling. When the market crashes, most people see fear. The intelligent investor sees opportunity. When the market is at an all-time high, most people get excited. The intelligent investor becomes cautious. Graham teaches the single greatest principle of safe investing, the margin of safety. The margin of safety means buying an investment at a price that is significantly below its true value. Think of it like building a bridge that can carry 10 tons, but only allowing 5 tons on it. If something goes wrong, the bridge still stands. When you buy stocks with a margin of safety, even if something goes wrong, you are protected. But when you buy overpriced stocks with no margin of safety, you are guaranteed to suffer heavy losses when anything unexpected happens. This principle is the foundation of Warren Buffett's entire strategy. Warren says that without a margin of safety, you are not investing, you are gambling. Graham explains that markets are always emotional and prices can be wrong. A company can be worth $100 per share, but the market may price it at $60 during a recession or hype it up to $150 during a bull run. The intelligent investor waits patiently until the price falls far below the company's true value and then buys with confidence. Another key idea Graham emphasizes is the difference between investing and speculating. But he also says that if you want to speculate for fun, you must follow strict rules. Rule 1, never speculate with money that you cannot afford to lose. Rule 2, never let speculation become more than 10% of your portfolio. Rule 3, never confuse speculation with real investing. Graham understood human psychology. He knew that people enjoy excitement, so he allows a small percentage for speculation, but he demands strict discipline. Then Graham focuses on one of the most practical ideas in the book, dollar cost averaging. This means investing a fixed amount of money at regular intervals, regardless of market conditions. By doing this, you automatically buy more shares when the market is down and fewer shares when the market is high. Over time, this strategy reduces emotional mistakes and builds wealth steadily. It is one of the safest and most effective strategies for defensive investors. Another essential concept is diversification. Graham explains that putting all your money in one stock is extremely dangerous. Even if the company is strong, unexpected events can destroy your investment. Intelligent investors diversify across multiple stocks, industries, and asset classes. But he also warns that too much diversification can reduce returns. You must find the right balance, usually somewhere between 10 to 30 carefully chosen companies. Graham then introduces the idea of defensive portfolio design. A defensive investor should mostly focus on high-quality bonds, index funds, stable large companies, and simple strategies. Graham recommends a portfolio split between stocks and bonds based on the investor's risk tolerance. For example, a 50-50 split or a 75-25 split, depending on your age and comfort level. The key is that the defensive investor does not try to beat the market. He tries to avoid mistakes and protect his wealth. On the other hand, the enterprising investor wants better returns and is willing to work harder. Graham explains that enterprising investors must search for undervalued companies. They should look for stocks priced below their intrinsic value. But they must be patient, analytical, and unemotional. They must study financial statements, understand earnings, analyze balance sheets, and check the company's long-term potential. Enterprising investors must also avoid hype, unrealistic promises, and market trends that look exciting but have no solid foundation. Graham explains that many investors fail because they spend too much time trying to predict the market. He says that nobody can consistently predict what the stock market will do in the short term. Not experts, not economists, not television analysts. Short-term predictions are noise. Intelligent investors focus on long-term value, real numbers, and business fundamentals. Another powerful idea from the book is the difference between price and value. Graham says price is what you pay. Value is what you get. A stock priced at $10 may be expensive if the company is weak. A stock priced at $100 may be cheap if the company is strong, profitable, and growing. Intelligent investors look at value, not price. They look at earnings, assets, cash flow, and long-term potential. Price is just the market's temporary opinion. Graham also warns against emotional biases. He explains that fear, greed, impatience, excitement, overconfidence, and panic are the biggest enemies of investors. Intelligent investing demands emotional discipline. When everyone is scared, you must stay calm. When everyone is excited, you must stay rational. Most investors fail not because of lack of knowledge, but because of lack of emotional control. Graham also emphasizes the importance of protecting yourself from inflation. Inflation reduces your purchasing power over time, so you must invest in assets that grow faster than inflation. Stocks, real estate, and inflation-protected bonds help protect your wealth. Keeping money in cash for long periods is dangerous because inflation slowly destroys its value. One of the final lessons from the book is that intelligent investing is simple but not easy. It requires patience. It requires discipline. It requires the ability to think independently. You cannot follow the crowd. You cannot chase excitement. You cannot panic when markets fall. You must believe in long-term value. Graham says that the market is a voting machine in the short term, but a weighing machine in the long term. In the short term, popularity and emotions move prices. In the long term, real value always wins. And here is the most powerful idea in the entire book. Your biggest advantage as an investor is your ability to think calmly while everyone else reacts emotionally. If you follow the principles of margin of safety, diversification, dollar cost averaging, rational decision-making, and long-term thinking, you will become an intelligent investor, not because you are smarter, but because you are wiser. And this is why Warren Buffett calls this book the best investing guide ever written, because it teaches you how to win not by beating others, but by avoiding mistakes and mastering your own emotions. Thank you for watching this summary of The Intelligent Investor. If you found value in this video, kindly subscribe to the Diary of an Investor for more powerful lessons on wealth, investing, and financial freedom. Your financial future starts with knowledge, and you just took a powerful step forward today.